Who has AI fears? Does AI make anybody kind of, I don't know, nervous? Does it make you kind of nervous a little bit? Does it make you feel like there's a lot going on in the world and it may be beyond everyone's control and comprehension, maybe even? I think it's kind of a weird, I get that feeling like the world is changing very, very quickly. And of course, we're trying to capture it. We've been doing very, very well, capturing it. I know some people have been fighting it, but I think retail's been doing pretty well. Retail's been doing pretty well. And we know that because we're going to talk about some of the reasons we know that, which is we watch flows, we watch what the flows are doing. We have all this wonderful information these days that allows us to really understand things that are kind of a little bit not bigger than the market, but have a big influence on the market. And being a derivatives trader, having been a market maker for a very long time, for 15 years, and really understanding some of these concepts from a time when they weren't really that important, right? So I was a pro options market maker. So a little bit about myself. If some of you do not know me, let me get my thing going here. Screen sharing. And let's get that chat back again. Okay. So thanks for coming, everyone. So I'm Hans Albrecht. I was a pro options market maker for 15 years. Trading long positions, short option positions, income, leverage, a lot of leverage actually back in the days. I stopped around 2013 before I became a fund manager. So back in those days, it was at least where I was, it was very much a client selling to the market makers kind of market. So you ended up buying lots of options all the time. And I know that might be kind of almost a little weird when you hear that, because a lot of folks these days are very much premium sellers. They're income traders, right? We do the cash secured puts, vertical spreads of various kinds. So that's really, that concept has really sort of captured the zeitgeist, right? That's the sort of, it's amazing. When I started trading, I don't want this to be a history of Hans and option markets, but when I started trading, that world was very, very small. And I was actually a big part of creating it and really kind of revolutionizing it to the way that they do things. Now, most of those funds still don't do things the way they should, but that was a small piece of the market. That market, in terms of the cover call AUM, the option income AUM, is 100 times as big right now than it was back then. So it's a very, very big thing. And of course, we've seen all these products come along, the individual stocks. So, you can do Tesla cover call product, you can do NVIDIA, you can do coin, you can do all these amazing stocks that you like, and layer that income on top of them. So they've become very, very popular. One of the biggest ones, of course, is the JPM collar. There's it's 23, $24 billion in size. And that's so big that it now has an effect on markets, right? So if you guys watch any of this stuff, you'll see people talk about the collar. It just actually was repositioned last month. So at the end of last month, they repositioned it. And so now it has, I think it's a 7,000 strike to the upside. They sell a call there, and that funds the put spread. They figure out the put spread, which gives them the protection, and then they sell the call way up high to pay for that, right? They figure out, well, what call can I sell as a covered call kind of thing to pay for that? So it's kind of hey, Vince, here's we got Vince here. Hey, Vince, good to see you. Good to see you. We got a very nice crowd. Thanks for showing up, everyone. So after I was a market maker for 15 years, income fund manager for a decade after that, managing a whole bunch of cover call income type funds, black swan downside protect funds. So really offense and defense. So the whole kit and caboodle as they say. And of course, everything today for education and information purposes only. It's your trade, your responsibility. So we are talking about things in a theoretical manner. I cannot speak for everybody out there. You are your own person with your own goals and your own situations. And so definitely check with an advisor if you want to do anything remotely close to what we're talking about today. So I wanted to put this out here. I saw this today. So volatility shares, 13 new 5-time leveraged single stock ETFs. Did you guys see that? And if you did, let me know. Gun to your head. So for those of you who don't know this, this means that on a daily basis, these products are going to give you, are designed to give you 5 times the performance of AMD. So if AMD goes up 1% in a day, this product should go up about 5%. It's never totally precise, and they do rebalance. The problem with these, the good thing is they give you that leverage. They give you that huge punch. The bad thing is they have to rebalance all the time. So on a big up day, I'm going to show you some things that relate to this in a moment. On a big up day, they buy the market, right? So they have to rebalance into the swap product. These things often use swaps, and they have to rebalance the underlying exposure in there. So they've got to buy on a big up day. Why? Because tomorrow they need to give you 5 times the performance again. And if they don't add assets to that product, that underlying basket, they're not going to be able to give you 5 times the performance. Now, what happens when they sell on a down day? Well, if AMD's down a whole bunch, then this product is going to own too much of the underlying, right? Because it owns enough to give you upside 5%, 5 times the performance. On the way down, it's over allocated, so they've got to sell. So what does that mean? A lot of people don't know this about these products. Is on the way up, on the way up, they're buying, and then on the way down, they're selling. And I'm going to show you how this affects things. The 𝐶𝐸, and there's a very simple math to it. I'm not going to get too far into it today. There's a video that I did on 𝐶𝐸. I've done a couple of them over time, and I'll post that here, where it explains the math behind it. But you can get, for example, you can get a product moving up 10% and back to where it started, and the leverage version has lost money. So you're back to where you started, but because of the reset, the movement, the volatility has now cost you NAV, right? It's cost you value of this fund. So these funds are not for the faint of heart, and they do have this sort of embedded, we call it short volatility, right? Short realized volatility. When there's a lot of movement, they get chopped up. So that's why these things can be a little bit risky. But so everyone give me your answer. If you have to own 2 of these, but you cannot sell them for the next 2 years, what are they going to be? You've got AMD, you've got Amazon, you've got Coin, you've got Circle, you've got Google, MSTR, what do they call that now? Strategy, NVIDIA, Palantir, Tesla, etc. Which 2 would you own? Gun to your head. Okay. James says Amazon and NVIDIA. I like that. That's a sensible, safe play. And you're going to presumably you're going to get less of the volatility that I'm talking about that's going to chop this product up. Are you going to get a lot of volatility in Solana? Yeah, you're going to get a lot of volatility there. So what that means is if something goes in a straight line with less down, more up, less down, nothing can give you no down. But if it's relatively, so let's take a look at the 𝐶𝐸, for example. So if I show you this, and those of you who saw my 𝐶𝐸 video from a few months ago, which is what everyone was kind of latching onto, and I had members make millions of dollars, literally millions of dollars on this trade. You can see that if this thing starts to move up in a very consistent way, and this is what I sensed, is that it's time to get into the space again because of AI, because of the importance of the build out, et cetera, and the inference phase, which you may have heard me talk about. But we had a little pullback here. So we had a little bit of consolidation in here, but then again, very, very strong move up. So it's based on the 𝐶𝐸s. And so if the 𝐶𝐸s, look at the 𝐶𝐸s here. So that's pretty steady, right? You got a few little dips in here, but that's pretty steady. When you get steady up, you're going to get some nice performance out of your leverage product. Now, the problem right now is you're getting more of this, right? You're getting more of this. The question is, does this continue? If it does continue to be volatile, the underlying, then you're going to get a little bit of chop. Okay, Vince says Ethereum and Palantir. Okay, you're swinging for the fences. I like it. Very nice. Amazon and Google. Ooh, I think those might be my two. But if I had to go with one dependable trade and one kind of crazier trade, I think it would be Google, believe it or not. Amazon's solid too. And then maybe I might go Ethereum. I might go with Vince on the first part there. Nvidia, Nvidia is pretty dependable too. Anyway, okay. So let's move on. So now we do have some interesting things that I've been noticing a little bit. So of course, the whole thing is that we just keep this economy just keeps performing. That doesn't mean there's some cracks under the hood, that there's some issues on the labor front, but we can see that here's your consensus, and this is really no different in most years, is that Wall Street, as smart as it is, as much as it has all these smart people, is really wrong a massive amount of the time. And so this big recession, this big sort of economic softness has really just not shown up. Now, we know that there are certain segments of the population that are suffering, that are dealing with the effects of inflation, et cetera, et cetera. So I don't want to belittle that fact. There are always people suffering out there, and that's certainly the case here. I think it is more of a haves and have-nots world, have-not world, and that's just the simple truth of it all. Is that I think that probably continues, right? We're creating millionaires and billionaires at a rate we've never seen before, and is that going to continue? Well, we're just early innings on inference, agentic AI, all these innovations that are coming out, companies that haven't been around for that long and have 100 million in revenue already. So we are creating incredible wealth, and that wealth is really, in all likelihood, going to be costing jobs, or at least slowing job growth. So you can sort of see here's your S&P 500. And you can see job openings, right? So now we had this big push after COVID, and we needed to hire. Well, the Amazons were hiring everybody, so there was some element of having to unwind some of that. But we can see there was another chart I don't have here. I'm sorry, but it shows productivity versus job growth, and it is stark, right? You see productivity rising in a similar way that it did in 2021. But the difference was in 2021, you had a lot of jobs being created with that innovation explosion. You needed people for the state of the environment back then. Now you don't need as many people. You can create with fewer people, et cetera. So this is something that we need to watch. This is something that Samantha often talks about. There's cracks below the surface, and I can't disagree with that. We will come to a point where if this does not translate into incredible innovation that now creates perhaps more opportunity broadly, then it's going to be a problem, right? So we have to concede that. Yes, you can give people universal basic income and things like that, but that's not, if any of you know Maslow's hierarchy, et cetera, this is not necessarily going to make many people happy. So you can pay people. It's not as easy as Vinod Khosla says, which is, hey, we're just going to have tons of time to do hobbies and have a nice life in this age of abundance. Well, that's easy for a billionaire to say, but it isn't easy for perhaps the average person to say. But the hope is that, and I want to build this case here, the hope is that this is going to happen. Look, this is happening here. I've been talking about this for months. I said, I think this is going to turn into a roaring 20s. Now, it's a bit of a Hail Mary, but I don't think a massive Hail Mary. I think this is more obvious than many people have felt for the past couple months, but I really do see that there is a renaissance happening. It's going to be a bit fractured. And so it's going to have uncertainty in how it plays out over time, right? We don't know exactly the winners, the losers, and it's going to be very disruptive. So our job in markets is going to be dealing with dispersion and disruption, because the reality of this new world is that it's very difficult to predict. And that's why I think they got option pricing wrong. And I said that a couple months ago. I said option pricing is completely wrong. If you're watching our show, I said it is not incorporating the possibility that we just don't know what's going to happen out there. I said exactly that. I said, look, we don't know where earnings are going to be. We don't know what companies are necessarily going to make it or not. We don't even know if some very big companies with massive moats are necessarily going to survive. There are people out there who think by 2030, we're going to have big companies, well-known companies that are basically out of business or running on fumes. So we don't know exactly how this is going to play out over time, but what we have to understand is that it's bigger than anything we have ever seen. This is bigger than the internet. This does not mean stocks are just going to go up. Don't misunderstand me. I'm not saying stocks are only ever going to go up, because at some point we're going to have to deal with some of these realities. But in the meantime, we're going to have an incredible explosion of productivity, et cetera, that I think is very, very exciting. And I hope that some of those negatives that we're thinking about find a way. Technology has always found ways to keep people employed. Look at what's happened over the last 67 years. Unemployment's never been lower, right? Look at the world and what technology has done. Now, I do think that AI is a little different. Do you guys think AI is a little bit different this time? Would any of you say so? When I say the internet came along and jobs are plentiful. We have more people in the world, jobs are plentiful, unemployment plunged in most places. What's the problem? What's the problem with technology? What do you guys think? Is AI different this time around? That is really the question. Because it is something we have never, ever faced before in terms of the sort of widespread effect that it's going to have. Yeah. You think it's bigger? Okay. Well, I agree. I think it's going to be crazy. I think it's something that's happening too fast, and that could be a problem. Now, one of the issues is I think there's something very interesting happening here, right? So let's talk about how we've seen profit margins just go to the moon. So what I want you to do is I want you to look at the 90s and into the 2000s. I want you to look at that as a period of setting the table, right? So what did the internet do? It set the table. It got people online. It got people emails. It got people getting involved in e-commerce. It eventually set the table for smartphones, for streaming. Remember when it took like 4 days to download a movie? Well, it set the stage for streaming and things like that, for very efficient modes of transmission through technology as they improved and improved and improved. So this was a big moment that set the stage for a couple decades of social media and all these great ways that we've sort of kept in touch with people and people that we don't want to keep in touch with. We have no choice anymore. But this is the reality of that. So I want you to think of what's happened now as setting the table, setting the stage for what comes next. So this has been about the semiconductors, been about NVIDIA, and I think it continues to be that in many cases because inference is nonstop, right? So training is kind of one and done. Think of it as that. It's not quite that simple, but inference is very much the gears never stop turning. And so here we are sort of in this stage where we are going to need more build out, significant more build out. But the big difference is, I think you can see the profits going right into these big stocks. I think this is a moment for mid cap, for small cap to actually begin to get to receive the baton from the big cap. Do they continue to do well? Yes, I think my roaring 20s is going to be kind of leapfrog, right? One does well, the other one takes the lead, and then the other one kind of catches up. And occasionally there will be names in there. Perhaps we're seeing software names, Salesforce, things like that, not do as well. So we start to see the effects of disruption on certain areas that are getting disintermediated and things like that. So the idea is that you're starting to see profitability sort of inch up. And I know the Russell is maybe not always the best example. It's got a lot of junk in there. But here we are curling up. Here's mid-cap starting to curl up on the earnings side. And I believe there is a transfer from what these guys have created to the broader economy. And that's something that gets me a little bit more positive about things, because the broader economy has so much more employment involved in it. And that's going to make a difference, right? The question is, are lower rates going to really help? Well, lower rates are probably going to push companies into just sort of investing in things that AI and processes that may not involve hiring more people. So we have to see how that plays out. But I think from an investor's perspective, and I hate to say it, because it's the reality of things, is that the companies are going to start posting better margins, and we're going to continue to see sentiment in certain parts of the economy where, for example, grads can't find jobs. That's going to be in direct, differentiation to the reality of companies doing better because they can perhaps do more with less, right? We see that from the financials, we see the Goldmans and the JPMs figuring out how to make things more efficient, how to find productivity, how to cut costs. What was it? JPM? No, it was Goldman CEO said we can do IPOs. Half of it, 95% of it, we can do with AI now. So this is the reality of AI starting to work its way into profit margins, but not necessarily into Main Street benefits. So we're going to keep an eye on that. But here's big cap right here. Look, approaching. So if we overlay what we've had recently, 2015 to now, if we overlay that over the previous 30 years that comes up into the .com area here, we can see that we're getting kind of expensive on a big cap basis. Now, you can look around. I mean, Walmart's really, really expensive. I mean, there are some big companies out there that are not cheap. So what's the answer? Well, the answer is that there is a large segment of the market that perhaps has not benefited as much yet. And so the idea is that, in my view, is that you start to see a bit of that broadening out, and you are seeing it. I often have talked about it on my show with Samantha, and you can see it is playing out today. Again, all-time highs in the IWM. That doesn't mean it's going to continue, but in my view, this new environment will be more volatile as we continue upwards, right? That's I traded the late 90s, and you just cannot go in a straight line. So make no mistake, you want to pay yourself. You want to pay yourself along the way. You want to buy put spreads, which I've been doing. I'm losing money on put spreads, but I'm playing that upside. I'm not doing a ton of callers, although right now we're starting to see a little bit better pricing out there. And I want to show you guys how that has started to inform me, because option pricing is one of those things that I use as the tea leaf to give me some insight into, when I see more and more exuberance or more and more complacency. So this is one of the things. So I wanted to talk quickly about, this is sort of very, very interesting. So the systematic flows that I often talk about, which are those sort of terminator funds that basically have to buy when volatility is low, and they have to sell when volatility is high, and they have different mandates slightly, and some of them are, have different metrics, 1 month, 3 months, there's different metrics involved in these. We can't paint them all with one picture, with one brush, but you can see that the way that they work is here's back in the day in April. And when this started bottoming out, I said, listen, there's nobody really left to sell from a systematic standpoint. We've seen incredible fear. It probably has no way to go but up from a support perspective, right? All we needed was some stability, which we got from Trump, in order to see stability, in order to see flows come back in, right? So these types of funds are buying as volatility drops. And they use realized volatility, right? So it's simple. They use the charts that we look at as option traders, and that's essentially what they're doing. So you can see here, as we head to late August, early September, they've already reallocated. I'm pointing to the bottom chart here. They've already reallocated. So they've pushed up from almost, fifth percentile, it says right here, to the 83rd percentile. And I said, well, still got a ways to go. Why not? Why not, right? Climbing the wall of fear. That's what we've been doing for months and months and months. And that's why around 5,600, 5,700, I said, we're melting up and, AI is going to help us. Here we go. 100th percentile right now. So when we look at how the market is acting right now, we can see that we're starting to kind of push up against a little bit of resistance. I want to show you guys some of the gamma that I'm seeing out there. Hold on, where's my little gamma chart? And that's giving us a little indication of where there might be a little bit of resistance that makes it difficult for the market to keep going, right? There's the big juicy positions that dealers have on. They're sitting there on large positions, and they need to hedge those, right? So this is kind of what I did when I was a market maker. Not kind of, it's what I did. You get to those strikes, and now you have a higher delta call. You can sell options. You can sell options against it. You can sell stock. You can sell futures. So it creates resistance to the upside when you have positive gamma. When you have negative gamma, you have the opposite. You have an accelerant. So really the idea is that if the market gets down to 6,400, 6,350, somewhere around there, really under 6,500, you start to get into sort of no positive gamma. And that's where some of these things start to take over. So I think people put a lot of importance on these things, on gamma. I mean, I think this is important, but on those gamma levels, I think they're important. Like, I lived it for 15 years, but I can tell you that it's not as clear as you think. And I know some people feel that it is. I know there are products out there that sort of bank on that. They really want you to think that that's what it's all about. It works when it works, and when it doesn't, sometimes they don't tell you about it. So it's like a lot of things in finance. It's like, okay, well, look where I was right. But when things do get violent, when we get a reaction, so I was absolutely, when we started to fall down to 5,800, 5,700 after that, during that big sell-off, that's when I started paying attention to that stuff, because that's what can act as an accelerant, right? On a daily basis, it could probably help if you're sort of an S&P floor trader type looking for like sort of little moves, and maybe trading 0 DTE can be a little bit more useful to know a lot of those levels. But we can see here that I'm not saying these funds are necessarily the be all and end all. So these funds that have to buy or have to sell, because they've done terribly. Look at this. These managed futures funds, these are specific ones that have done absolutely terribly. So they have not navigated this environment very well at all. Professionals have not navigated this environment very well at all. Retail's done pretty well. They were buying all the way out of April. So it's a market where that's giving a bit of fuel to the upside, right? So there's this FOMO that is associated with a market hitting all-time highs, where sentiment in some respects is not that high. It has come up, but it's not that high. And that means that there are more people potentially to get in. That's probably part of the reason that we just keep bouncing off of these little sell-offs, right? So what happened on Friday? Well, we bounce right back again. So if we can get 2 or 3 days down, then that could turn into 12 or 15 days down. But if we don't, then it's going to be this sort of persistent sort of bid that's in this market. People are just going towards the end of the year, and if they're underperforming, then they have to buy. Now, I wanted to tell you quickly about these funds. So remember I told you about those levered funds, right? So the 2-time, 3-time, 5-time now that we've got. Well, this is how they work. They sell on the way down. So this is what I was telling you. On down days, guess what? Down 2% day, they've got a massive amount to sell, 88 billion. On a 4% down day, they've got 200 billion to rebalance. They have no choice. They're not saying, well, maybe I won't sell. They have no choice. So the bigger the move, the bigger the rebalance. And my takeaway from that, what you might take away from this, is it's more evidence of how option markets and volatility cluster more than ever. They're either just kind of moving up and there's not much volatility, and we know that's what we've been experiencing, or all hell breaks loose and volatility feeds on itself. Vol begets vol. And what that means is volatility clusters. It's either contained or these things are helping to push the snowball down the hill, and then everybody knows it's happening, so pros are pushing down even more, and it's like everyone's playing leapfrog, and it becomes a bit of you're gaming kind of what has to happen. You know that the more you can sort of contribute to the push down, the more that the push down is going to happen. A bigger push down is going to happen. So look at the AUM in these products. Look at this. They pulled back in April. So this was a nice, healthy pullback. They've gone to new highs by a lot. So people continue to add AUM, that means assets under management, into these levered products. And where do those levered products live? Not in Pfizer. They live in what is already the more volatile areas of the market. So you already have areas like semiconductors, which are inherently going to be more volatile. And then you've got the leveraged AUM in these tech and AI areas that are going to move that even more. So when the clamp breaks, it can get worse. A down 2% day, don't be surprised if we end up down 3%. Don't mark my words, but this is the nature of markets now, is that we can get going down in one direction and it continues. 1% sell-offs probably get bought a good chunk of the time. 0.5%, 1%, a little bit more. That's in the realm of, there are enough people out there who are underinvested that they're going to buy that. So this is really the world that we're in. And so again, this is the 𝐃𝐨𝐽 where you want to be careful. You want to be careful. If this is now a very volatile sector, I'm not saying it's terrible, because I think that build out continues. And in fact, I would say that the build out of AI at this point can spread a little bit more. AI at the edge, AI more inference focused. There's some companies that do most of it well, like in NVIDIA. They're just incredible at many, many different areas. But there are many sort of other semiconductor companies that, that now start to do things. AI at the edge, right? AI, you can't have a vehicle, you can't have a car that needs a split second to figure something out. You don't have a split second. You need AI to work right away, on the edge, we call that, like literally right away, right? So we are going to be entering into a world where there is more robotics, more automation. We've got these, Tesla robots coming. We've got all kinds of stuff happening. We've got Internet of Things, which is basically everything around you going to be infused with this technology and the ability to generate insight, right? So everything around us is going to be connected. It's going to be like ridiculous. And they're going to need smaller chips and efficient chips and AI capable chips. And so I think there are other opportunities there. I think memory is big. Micron's one of my favorite trades. 𝐃𝐨𝐽, we were talking about that in the chat today, in the chat room. We have a community, VIP trading room community where we have tons and tons of people just sharing ideas. And of course, I'm in there guiding people. By the way, I've got a product that has just been a smash hit called Leaps Trader. I've got a crypto trader product as well. I've got my Discord community. I've got some really, really exciting stuff coming over the next month or two, like really exciting, like game-changing stuff. So I'm known to give people the real deal. No guarantees, but I'm really always thinking of real ways to help people other than just, hey, sell a put on a red day. Like that couldn't be any more simple. That's not how you get things done in the real world of trading. It can work for some time. So this is what we've really dealt with over some time here, which is spot up, vol up. Spot up, vol up. What does that mean? Anybody know what that means? Spot up, vol up. Something that we have been seeing quite a bit lately. Spot up, vol up. Well, it means the market is going up and the VIX is going up, right? So the VIX being the volatility index, the fear index that everybody watches, when it goes up, tends to mean that stocks are coming down. And when stocks are going up, the VIX tends to come down. That's people are less fearful. They're less prone to be buying insurance, buying downside protection. And that's just how that's how that index typically works. Say 80% of the time. Lately, we've seen a lot of market up, VIX up. And part of that is what I basically said would happen a couple of months ago. I said, listen, we're going to enter a mania. The mania is coming. The mania is coming. And here's the gamma stuff I'm going to show you guys in a moment. The mania is coming, and the mania is going to be associated with, here's that one I was looking for. There we go. So here's somebody, I said this would happen 3 months ago. I said, we're going to get the mania. It's going to be driven by flows, people being offside, and it's going to be driven by AI. And I looked at certain things, and I looked at like option pricing on Micron, for example. It was trading at multi-year lows. And I'm going, how are option prices? And I said this on all my shows with Samantha. I said, how are option prices not recognizing that the world is about to change in a very big way? Good, bad, disruptive way. And they've jumped up. So that's what you're seeing, is you're seeing that option pricing has really come to reflect a new reality, which is, I'm going to show you an example of that. Oh, I actually have it right on here. You can see here's your Micron. So if you guys watch my show lately, you can see here what happened. In April, we had option pricing take off. That's normal, right? That makes sense. Option pricing went up because the market fell down. And then everything came down with the market rallied back, and we got to these really, really low levels. And then as the market melted up, this is what happened. So this is fascinating, right? This is option pricing rising into fear, which makes more sense. And this is option pricing rising into upside, the fear of missing upside. It's rising into FOMO. It's a crash up, right? Crash down, crash up. And this is why I got rid of many of my positions that I'd purchased down in here, because I'd made money on Delta upside. I'd made money on Vega, which is your exposure to option pricing rising. And I made money on 𝐃𝐨, which is kind of Vega, VAMA kind of stuff. You basically have that upside kind of pushing up, the velocity of that upside pushing up. So, nice ways to make money. And I actually kind of feel like IWM is not a bad place to be right now. Now, it's an index, right? It's not Micron. And by the way, that we did not just see that in Micron. We saw that everywhere in big caps, solid, stable names. This happened everywhere. And I said that I did a special situations show months ago. And I said, you're going to see the call inversion. You're going to see skew inversion happen in a big way. And that's exactly what happened. That it spread to all areas of the market, this sort of upside FOMO expression in option pricing. And so now we kind of have a little bit of a different environment. So when I'm talking to members and in Leaps Trader or wherever in the community, I say, listen, you have to get a little bit more creative. It's not as simple as buying a whole bunch of cheap out of the monies. You've had the stocks move up and now everything's super, super expensive. That's a different reality for you, right? So now if you want to play continued upside, it's more expensive. The stocks have had really, really good runs. They could continue, but you're going to look at different things. So we look at things like broken wing butterflies. We look at call spreads. You want to spread out that risk a little bit. And so you want to get just a little bit more creative in terms of those option Greeks. You want to be aware of that dashboard, right? So if you use Thinkorswim or one of these programs, you want to be aware of your exposure, your Greek exposure. That's like if you're a pilot. I was a pilot and I had those instruments in front of me, right? So those are telling me what's my attitude, what's my engine looking like? Is it still running? Good, that's great. Actually, I lost my power once over the Laurentian Mountains north of Montreal. I literally lost all my electric power and ended up in a hailstorm, and that was really fun. That was a little scarier than being in the trading pit. But if you look at IWM, it's definitely come off the bottom, but it's not crazy expensive. So if my thesis plays out and we do get this nice push in that broader world, I think you could play individual names, right? So I think some individual names look interesting. Rocket, I think Zillow, I think those are kind of interesting names that have nice exposure to parts of the economy that have been forgotten for a little while, right? So you can kind of see like some more positive vibes from housing and real estate and things like that. We do need that 30-year. We need mortgage rates to continue to come down, but I don't think it is 100% crucial. And I said this in the community last week. I said, listen, I think there could be a little opportunity in here on the broadening trades, which is everyone thinks it's all about rates coming down. But I don't think that's all it is. I think there is a broadening happening potentially that is going to be at least as important as rates come down, perhaps more important. So the opportunity could come in some of these areas where the market, which can only concentrate on so many things at one time, will say, we're maybe not going to get those massive rate cuts because inflation kind of has to be a bit sticky if we're going to have this amazing, infrastructure build out and all that power. There won't be enough power. So, power costs are already going up around the country. So it's going to be hard for inflation to plunge. Growth can overcome that. I don't think the market will necessarily care as long as growth is great. So where people are getting it wrong is you don't need inflation back to 2% for markets to do well, right? In my opinion. And so I think there's going to be opportunity in areas of broadening where we have forgotten about them and they traded a better multiple than many of the big caps, right? So it's this world where I have been, I put it on Twitter yesterday. I said, listen, I'm a little bit less convicted on semiconductors, some of the equipment that I'd done well on, right? The SOXO trade, all that stuff. I mean, this has all been really great stuff. MU, I still like, right? So I'm going to pick and choose a little bit. So I've gone from, you can make money on a whole basket of things to once the market recognizes the value, right? There's sort of different stages you can be at. There's a part of the stage where the market just has the narrative wrong, which we nailed, right, with our trade. So we said they're just not recognizing all this stuff. So now we've moved up to where, okay, it's no secret that there's this new phase is happening and semiconductors have done well as a result. Now you have to kind of go, okay, it's no longer AI floats all boats necessarily. You may want to look for, so, I said, a couple of weeks ago, I said AVGO, maybe not, but Micron, yes. And that, they did what they should have done, which was Micron did well and AVGO kind of hasn't, it had a big jump the other day on a deal, but it really hasn't done a whole lot since then. So it may be a case of story is important. And I know that in a story-driven market, which is what this is, I want to show you guys one of the most important charts that I look at. Hold on one sec. Because everyone's looking for the top. And I keep saying, look, I get it. There's a bubble in some areas. I'm not saying there's no bubble, right? Everyone thinks, oh, Hans doesn't think there's they're NVIDIA trading less than where it was years ago from a metric basis. That's not a bubble. Cisco was 100 times earnings plus in the .com. NVIDIA is cheap. Now it has problems. There's China. There's, maybe the build out slows at some point. These companies can't just keep building like this forever. So there are some reasons I think for the multiple not being insane. I still like it. I think it goes to 225 plus, but I'm just saying there may be some lower hanging fruit out there, right? If there's a lower hanging fruit, then I can shift a little bit. And if I'm worried I'm going to miss it, I can always push back in and create some sort of upside, strategy that's going to play the upside in those areas that maybe I've moved out of a little bit. But, I definitely want to own some Micron. So I'm watching that and I'm thinking memory is massive. We're already seeing shortages. We're seeing prices go sky high. We are going to see an absolute complete shortage. It's an area of the market that people have not recognized. That's why I jumped into it. And I didn't get in early. I missed a good run. But now memory, the STXs, the WZDCs, the Micron, those are, different kinds of things. But memory is going to be exceptionally important. We're going to create so much freaking data. We have no clue where to put it. We see Equinix starting to go. I think Amazon's going to benefit from that. I think they're getting that wrong. We've seen Bezos's ex-wife selling tons of stock. Maybe that has something to do with it. I know that's one person, but I think that there's some interesting plays in there. I'd be looking at Nebius on a further pullback. We're seeing it pull back pretty good. I got into that in the 30s. And it got up to around 120, 130. We did amazing in that. So anyway, we don't have to talk about everything today because we've got a lot of shows. I want to try to do this every week if people are interested. Let me show you. Let me show you my trade. I mentioned in the chat that I want to show you guys one of the stocks. Now, this is not for the faint of heart, okay? This is called Figma. Now, Figma is a company that is not so under the radar, even though you may not have heard of it, because it is very much a part of the sort of user interface world. So where you go out and you say, well, listen, I want a user interface that's going to, give me that's going to give me a bunch of stocks that are breaking out and or whatever. It could be like a business. You want to run a nutrition business. You want an interface that people can log into and get all sorts of information from. Anyway, whatever it is, it really speaks to a very big trend that has really started to catch on a little bit. You may have heard of agentic AI. So the idea is that AI it's amazing, right? Using ChatGPT is amazing, but it is in and of itself is just kind of a broad product, right? It's a broad tool. Agentic is where you, and this is where you're going to see incredible innovation, is where you come in and you say, I'm going to use AI to solve a solution. I'm going to use AI to create a product, an app, a user interface, whatever. It's going to play into all kinds of things. And these guys are used by something like 90% of the Fortune 500. It is absolutely ingrained as sort of as the premier design portion. So these guys are mostly about designing and then creating that front end that's going to connect to the back end where all the calculations and magic happens. They connect to the front end. And I love this stock even before this big news came out a couple of weeks ago, which was ChatGPT, OpenAI, which is ChatGPT. They are now working with Figma within their ecosystem to create, to help people create things. And so the idea, I think that's very interesting because number one of the big problems with software is we've heard this, you may have heard this, AI is going to eat software. It's going to eat software. It's going to do everything, right? AI is going to do everything. You're not going to need software. It's part of why Salesforce has struggled. Adobe has struggled. I think it's overdone, but I do think it's moving faster than we realize. That's the thing with AI is it really is moving fast and it's absorbing money from everywhere to support innovation initiatives, and that's making things move even faster. There's just so much money being pushed at these things. So we are seeing that it probably is true over 3, 4, 5 years that we are going to see a threat from AI to sort of disintermediate, in a sense, the very platforms that help people do things, right? So software that bring people together. They have data and tools, and there are people on one, and they sit in the middle and create that interface. AI is going to be able to do a lot of that. But what I love about this news is that ChatGPT said, listen, instead of, and I think it takes the existential threat off the table for Figma, right? Which I don't think there was a massive threat there to begin with, but it's basically saying, if you were worried about AI eating this software. It's now they're cooperating with the software. They're saying, come on in, and we're going to give you another 800 million sets of eyeballs to look at you and figure out how to use you. Now, are they going to pay ChatGPT? Of course, they're going to pay OpenAI, and there's going to be there's some sort of deal there. But these guys are so big that I imagine they had pretty good leverage in the negotiation. And I think this just opens up the world to them. It doesn't mean they can't continue doing what they already do. They have massive, massive saturation throughout the economy with companies. And so they kind of get the best of both worlds in a sense. So I think this is a really, really cool stock. I've been buying since the 50s. I bought down in the low 50s. So we've got some trades that have done well in Leaps Trader, for example, and outside in some personal accounts. But what I'm looking at right now, for example, is one thing is we're getting nice juicy skew here. So what happens with a stock like this is you start to see people get excited and push up those out of the money calls. Remember, we talked about that with Micron. We pushed up those out of the money calls, and because people are excited, they're FOMOing. Maybe it's shorts having to cover by buying calls, protect the upside, whatever the reason is. Dealers short gamma up there, and they have to buy single name, right? That's where a lot of this is happening. It's happening very much in the sort of single name area, where these vols are exploding and things are going nuts. Because you're getting steep skew. So one thing that I looked at today, which is now the spreads have gone really, really wide here, but you can buy a 7100 for about $5.10. So that's a January. That's going to expire in 3 months. So you've got 93 days for something like that. And you're going to risk on a one lot, you can risk $510, but you have the potential to technically make $30. Right? Less the $5 that you spent. So it's a kind of potential 5-bagger, but it isn't, right? Because we know that with spreads, we're not going to wait for that, probably not wait for that full spread to play out if the stock is over $100. So there's sort of an idea that you look at that and you go, oh my gosh, I can make all this money. But the reality of it is kind of like with butterflies. Everyone's like, look, I can make this massive amount of money up here, but nobody waits for that tent to play out and for everything to expire. Like you don't do that. So you've got this upside. So it's a nice play because what it does is it's going to get you in on something that is not a cheap option pricing type play, right? This is not Apple. This is trades at a 90 to 110 implied volatility. That is not for the faint of heart. But by selling that upside 100 call, you are now doing two things. You're reducing your delta. So if you just bought the 70, you'd be super long, balls to the wall. You're hoping this thing goes up. But you're also long a lot of Vega, right? So you have this Vega and time decay because you're paying up for these options. That may be okay for some people, but if you sell that upper 100, you're reducing that Vega exposure, you're reducing delta a little bit, but you're spreading out your Vega risk, right? So you're buying maybe a 90, you're selling 100 vol, you're getting a nice 10-point spread because of that upside skew. So when you have big juicy skew to the upside or the downside, if you're buying a put spread, when you have that juicy pricing, you are playing it correctly and you're going to get nicer pricing, right? If the pricing wasn't so good, if that skew wasn't so healthy, you might, for the same price, you might only get a 70-95, but now you get a 70-100. So you get that nice pricing playing into this scenario for you, and you can kind of see how it plays out. Now, what I am going to do is, as I put more of these on, if it pulls back a little bit, I'm going to watch that downside and see if it remains pretty expensive. It'll probably come down a little because this is sort of we're now in a new bizarro world where as things go up, option prices go up. And as things go down, the market says, oh, okay, we're no longer in a melt up. So we're going to price in, a more stable reality. So this is how manias work, right? So it's not business as usual. If we see the S&P push towards 7,000, it's going to be really hard for the VIX to stay low and for option prices to stay low because we are pushing into a mania, right? The option market has to reflect that at some point. So that's basically how I'm looking at something like this. So I hope you guys enjoyed that. Wow, we did a whole hour. I can't stop talking. Does anybody have any questions at all about anything? Nope. No questions today. Doug, Vince, come on, give me some stuff. Give me something. All right, guys, you know what? I gotta get running. I gotta do a video for somebody else. But thank you for coming to the inaugural Turbo Trader show. And I'm gonna try to do this every Wednesday. And bring your questions next time, and we can chit chat about things. I'll try to do maybe a little bit more of half an hour of talking about stuff, and then we'll open it up to Q&A, and we can see what people are thinking. Okay. Thanks very much, and we will see you next time. Check us out, optionswithhans.com. Check out Leaps Trader. We just raised the price on it, but if you ask, I could be convinced to convince Natasha to give you the old coupon. So anyway, great community there. We're having lots of fun, making tons of money. I won't tell you the track record. It's kind of stupidly good. No guarantees that it continues, but it's insane. But for now, everyone have a wonderful night, and we shall see you next time.